Well, let's now turn to the advisory. Our next guest saying that the recent correction is a reminder that markets move in cycles and investors are better off staying disciplined rather than trying to time the downturn. Roger Perrett joining us from Freshwater Wealth. Roger, welcome back.
Thanks, Andrew.
Yeah, don't panic. I mean, that's obviously the mantra you use, isn't it? Because it is easy to do so in an environment such as this. So let's take a look at what's actually driving the market lower at the moment. And it is off that news flow that's constant out of the Middle East, isn't it?
Yeah, that's right. I think there's probably three big things. So one, as you say, is the events happening in the Middle East, restricting oil, pushing up energy prices. The second one is then the inflation effect. So we're getting higher inflation in Australia. I think the OECD is suggesting that Australia could have one of the highest levels of inflation as a result of what's going on. So we've got the threat of interest rates going up as well. And I think the third one is just the psychological component where people are feeling fearful, thinking, this could be the end or this could be disastrous, and, potentially selling and causing the market to fall away further.
Well, it does raise that question of whether you can time a market like this, and inevitably you're going to be looking and saying, I could have sold when this got underway because it wasn't going to be solved easily. We could foresee that, well, perhaps many saying that we were due for a correction anyway.
Yeah.
What do you say to investors? I guess those particularly that are in the market for the long term.
No, that's right. Yeah, we call it like hindsight bias. That we could have seen this could happen, but looking back, it's much easier because no one has a crystal ball, and it's very difficult to see it play out. But like I've seen it in the past, the markets react unexpectedly as well. I remember when Trump was elected the first time in America. While the votes were being counted, the market did not like the outcome that Trump was going to be elected. And then when he came out and did his victory speech, the market absolutely took off. So all those people who were thinking it was going to go down, and like you say, maybe I should have got out, they were actually the ones that lost out because the market then rallied. So I think no one's got a crystal ball, and to your point, it's just best to hold.
So, but is it as simple as selling early, buying the dip? But of course, once again, it's a question of timing, and who knows where the dip is.
Yeah, that's right. Yeah, there's interesting research out of the US from Dalbar. Dalbar is like a investment research house, and they basically did some research and have done this for many years, 20 odd years, I think, in terms of investor behaviour versus performance. And what they found was, as an example, in 2025, the S&P went up 25%, but investors' portfolios only went up 16%. You may recall this time last year we had a correction with the tariffs and things like that. So clearly investors were trying to time the market, yet they ended up 9% behind the person who basically just held for the whole year. So this research is suggesting that Dalbar are saying that investors only get the decision 25% right. So you can imagine if you're going to be buying and selling and trying to time it, you've got to get it right twice. You've got to get it right when you sell, and then you've got to get it right when you buy. So with 25%, the odds aren't great at all. Sorry.
No, I was just going to say, so can we draw on history and look at previous market corrections, perhaps as to a view as to how this may well play out?
Yeah, I think so. Yeah, I think since the 1940s, every time there's been a correction up to around about 10%, every single time the market within 5 years is well and truly higher than what it was. So I think absolutely. I've been through many corrections over the years with the Asian crisis, September 11, the GFC, COVID, etc. And although every situation is different, and although there's a lot of similarities, because during the chaos, a lot of people think this is it. It's going to go down. It's going to get worse. The thing that always happens is that the market always recovers. I have a strong belief in humans. We have a great track record of solving these things and coming out the other side. And I think that's why I have absolute confidence that in the future the market will be higher than it is today.
It's also a question, I guess, just how conservative you want to be at the moment, because a lot of the safe havens have not worked out this time around. Particularly in a moment of geopolitical crisis, you would think bonds, gold, I mean, they would be the places to be. And they have gone the opposite direction, perhaps, to what you would think. So is cash the place to be?
Yeah, I think that's often like if people are fearful and concerned, their immediate reaction is, I don't know where I'm going to put it, but let's just put it in cash. The issue with cash is, and especially at this time where we've got inflation increasing and potentially going to be higher result of what's going on, leaving money in cash is you're just eroding your buying power. So it's almost like you're guaranteed to be losing money. Whereas at least with the market sitting tight, looking at those stats we just shared, we know down the long term we'll be fine and you'll make money. So I think that's preferable as long as you've got the right time frame and risk profile to potentially avoid cash, unless you really need the money, of course.
Well, indeed. But if you do have that longer term investment time frame in mind, particularly with a view to your retirement savings, do you just ride this out?
Yeah, I think so. I think there's a couple of key things. It's really important to have the diversified portfolio, the portfolio that's aligned to your risk profile. So hopefully before you got in, you're well aware of the volatility that the portfolio may exhibit. So although no one likes it, you understand this is normal behaviour. There's nothing to be shocked about. And I think the other one is just making sure that we've always got a cash buffer. For people who are retired, the worst thing one of the worst things you can do is invest every single cent, because next month when you're wanting to withdraw money for the grocery bills, you may then be forced to sell when it's down to make those withdrawals and to pay for living expenses. So I always find having at least 12 months worth of withdrawals or living expenses in cash is a really good guide, because then it doesn't matter if the market corrects, you're not a forced seller, you've got plenty of cash to ride it out for at least a year, and you can write off the income as well that's being generated from the investments.